Why is golf like investing? That's what we're answering today. So what we're going to talk about, we're going to go through asset allocation, which is the most powerful thing you can do with your money. So we're going to talk about why you invest. We're going to talk about what you can do to invest, like what strategy you can use, which assets you can invest in. Then we're going to talk about how, so essentially how you at home or how you're watching on your phone can essentially invest and what type of investments you can use. So asset allocation, it's essentially how you put your different there are different asset classes. So things like cash, the pound in your back pocket, bonds where you're lending your money to companies, or you can lend to governments, or you can buy shares, which you're essentially becoming an owner of that company, that business. Or you can buy property, which is like the roof over your head, or like residential property. So there's different asset classes, and they all have different personality types, and you basically pick your team, your asset club, depending on what you want out of life. So the first thing you need to know, so everyone today is an investor. So you at home, you are an investor. You have a pound coin in your back pocket, and that means you're investing. If it's just sat there, it's getting eroded by inflation, which means the pound coin in your back pocket is losing value just by sitting there. So that's cash, for instance. You also have different asset classes that we're going to explain in this video. So you also have, so why are you investing? So if you work for a company, that company now has to what they call auto-enroll you into a pension. So if you work for a company, you're now investing into a pension automatically, which is great. You don't even have to think about it. But what you do need to understand is asset allocation. And that's what we're going to explain in this video. And we're going to go through why golf is like investing. So let's get through it. So the first thing you need to understand is, what are your aims and objectives? So think of it like a game of golf. So you have to head the game of golf. The aim of the game is to get your ball in the hole. But first of all, you need to understand where the hole is. Where are you going to hit the ball? Where essentially you need to understand your aims and objectives. So what you want out of life. So paint me a picture where you're going to be in 5, 10, 20 years time, and then you want to head towards that as your goal. So I see so many people today starting investing and they don't know where they're heading. So essentially they don't know what direction they're going to head towards. So once you know your aims and objectives, then you can be like, right, that's where I want to head toward, and then you can play towards that. And it's going to save you so much time going off course than, once you know. So you need to know your aims and objectives and what your aims. And also you need to know your time frame. So how long are you investing for? So different strategies depending on how long your time frame are. So different asset classes work depending on your time frame. So think of it like golf. So it's a bit like having different clubs, and essentially different clubs perform differently depending on how far you want to hit the ball, or how far you want to get to the pin or the hole. So if your aims and objectives are shorter, it's going to be a different strategy than if your aims and objectives are longer. So if your aims and objectives are, say, just to save up for a holiday, for instance, or even to save up to buy a house, a deposit for a house, then you're going to be much more closer to your goals. So you want to have, say, a putter. Use a putter, which is like cash. Cash is like your putter. So it's like very short distances, maybe like 1 to 2 years. So if your goals are to buy a house in 1 to 2 years, you don't necessarily want to be buying shares. You don't want to be putting money into shares because they can move up and down, and you're more likely to, essentially, you don't want to be taking your money out in a down market because you're going to be losing money. So that's cash. So cash are very short term. And then, so the next one would be bonds. So let's face it, bonds are boring. There's no getting around it. Unfortunately, they're a bit boring, but essentially you're lending money to companies or governments. So think of it like premium bonds. It's what your gran maybe bought you as a kid, because they're deemed to be quite safe assets. You lend money to the government. If they don't have enough money, they will just print off more money, essentially, like quantitative easing, what they did in 2008 after the financial crash. So that's bonds. So that may be, I don't know, maybe like 2 to 3 years. And bonds are great to getting you out of a sticky situation. Think of them like, if you, like coming back to golf, if you are in a bunker, for instance, if the market's crashed and you're in a downturn, they can kind of get you out of a sticky situation because you're lending money and you're not owning the company, so you're taking less risk. So essentially, if you're borrowing money, you're lending money to a company, and that's less risky than actually buying part of the company, which is shares, which we're going to go on to next. So bonds are where you're lending money, and that would be more of maybe 2 to 3 years. And then think of it like, we come to shares, and that maybe be 5 years plus. And shares are much more of a long-term strategy. So if you're not going to be taking your money out for 5, 10, 20 years time, it's much more beneficial to buy shares, because with the risk, they're more likely to come down. There's much more rewards. You're much more likely to get more money back in shares. If you look historically, going back to like 1750, you can go back and look at that data, and shares outperform most other asset classes. So think of it like they go up and down more. Shares are much more likely to go up and down. It's a bit like teeing off, and if you tee off with a big Bertha driver, for instance, it's much more likely to go off onto kind of the fairways, into kind of, you might hit it here and end up in the rough. So you might even go, if you're having like small companies, so small growing companies are much more risky. So they are even more, the volatility is much higher. But with that volatility, you get much more reward. So think of it like with that risk, because you're taking more risk, you're going to get much more rewards. So with small shares, there's much more ups and downs, looking at the evidence, looking back at historical figures. So if you're investing for 20 years, it's more beneficial to have small growing companies, because in 10, 20 years time, these small companies are going to be much bigger, and they're going to be the companies that are going to be producing profits, and they're going to be giving you a dividend, which is part of the profits. So yeah, just to highlight why golf is like investing. It's like so think of it like asset allocation. So you've got your bag of clubs, and essentially you can pick which clubs you want for how far your aims and objectives are, which is like the pin. And once you know your aims and objectives, then you can pick your strategy. And you don't need to have one or two. You like a bag of golf clubs. You can mix and match depending on your strategy. You can have multi-assets, and essentially you can build the clubs that are right for you. And even if the market is efficient, we humans aren't. So we look at the effective market and essentially pick the strategy that's right for you. So think of it like, so if it's short-term goals, then cash. It's 1 to 2 years, it's like a putter on the green. It's not going to go, the volatility is very small. So if you putt the ball, it's less likely to kind of go off on a massive tangent. In bonds, they're a little bit more risky, but it's kind of a longer time frame. They get you out of a sticky situation. They're a bit like getting you out of a bunker, because in a downturn, in a market crash, they hold their value much better than shares. And then, so for even longer term, 5 years plus, you can have like your shares are like the driver. They're gonna get you much further. They're gonna get you to your goal much quicker than, say, a putter. Than if you're starting off, if you're teeing off and you just hit a putter with like cash, it's going to take you ages to get you to the pin. Whereas if you have a driver like shared, you can just drive off and it's going to get you much further. But then you take that risk of you maybe end up a little bit kind of that kind of the ups and downs, that kind of volatility. You might end up in the rough, or you might end up in the river even, which is probably not ideal. But yeah, so it's risk and reward are related. So to summarise, asset allocation is the most powerful thing you can do with your money. Why is golf like investing? So it's like each club is like designed for a different purpose. So understand your goals, your aims and objectives, and yeah, and it depends on your time. So time in the market rather than time in the market is really important with investing. So my name's Neil Doyle. I'm the author of Football Formation Asset Allocation, also the creator of Football Formation, Asset Allocation, the game. My book is called Millennial Money Mindset. If you want the fruits, you need the roots. It's available on Amazon. Yeah, my company's called Money Tips, which stands for Tax, Investment, Property, Pension, Savings. My YouTube channel is Millennial Money Mindset, so please like, please subscribe. Please tell one person about my golf analogy, and hope that helped you out.